We focused a lot over the last day and a half on the compelling opportunity set that U.S. commercial real estate fundamentals have, but I wanted to shine a light on the conditions in transaction markets and capital formation markets that are going to influence kind of the ways people are going to have to think about structuring and deploying in this next cycle in order to capitalize on that. So first, a quick, we've covered this several times, but how did we get here? Coming out of the pandemic, we saw a surge in inflation as economies reopened, supply chains were disrupted, fiscal stimulus and overheated, labor markets resulted in a global inflation surge. Central banks responded accordingly, rapidly raising interest rates to levels we hadn't seen since pre-GFC, and as a result, we saw a dislocation in commercial real estate pricing. So I'm showing the NCREIF Odyssey Index here. You can look at CPPI, public markets, but depending on what measure you look at, anywhere from 15 to 30% a downdraft in pricing. And what this has created is a massive bid-ask spread in transaction markets. You have new capital that wants to enter at much more compelling valuations of today in a new interest rate environment, in a new backdrop, but a lot of sellers remain anchored to the previous valuation cycle. Mike had a great chart yesterday showing the amount of capital deployment that occurred in the 2020-2021 period at record low cap rates and very heavily and aggressively financed. And as a result, they're kind of stuck. They can't accept what the current valuations are, and that's reflecting in transaction volume here on the left. From peak levels, we're down 50%. Those were probably inflated and a little bubbly. But if you look at the long-term run rate pre-COVID from about 2014 to 2019, we're still down around 25-30% in terms of transaction volume from what I would consider a normalized, healthy market. I think the other thing that's occurred is in the wake of the interest rate, raising cycle, we saw stress in the U.S. banking system. Now, I agree with the comments yesterday that I don't think there's any risk of, financial crisis. The U.S. financial system is sound and stable, particularly the systemically important large institutions. But it's a little less true on the regional banking side. We saw, Silicon Valley Bank, Federal Reserve, the First Republic and New York Common all really kind of shut down and struggle, and the Fed have to come in and intervene. The outgrowth of that has been a massive drop in net lending to commercial real estate. Regional banks have been pretty much solely responsible for the credit creation in U.S. commercial real estate since the GFC. There was post-GFC regulations that really took the systemically large banks out of this market. And so, 75-80% of that post-GFC net